Girish Nadkarni, Executive Head of Avendus Capital, joins us live now. Girish, morning. Thank you for joining us. Girish, given the kind of environment we are in, what are you advising your clients? Are you advising your clients that it's time to buy fear, put money to work, or these are dangerous times and such an uncertain environment, it warrants extreme amount of caution?
I wouldn't say extreme amount of caution. I think the markets have reacted to a certain extent. The outlook certainly is not, very hopeful at the moment. There are enough problems domestically and globally, and therefore, the short term there is certainly a lot of weakness that will get played out. Having said that, I think in most sectors, with the GDP growing at such a slow rate, the expectation is that there will be hopefully a monetary easing that will happen in the next couple of months, and with that there is hope that interest rates will come off over the second or third quarter of this year, and consequently there should be some boost to the corporate sector. So outlook also in terms of valuations on a broad market, they are fairly reasonable. So from a long term perspective, I think it's a good time to begin accumulating stocks, but with the caveat that short term there is certainly a weakness for a month or so.
So Girish, what is it that you would expect by way of GDP, considering last week that was the big shocker, the 5.3% mark? What are the markets pricing in? 2 more quarters of weakness?
I would think so. I think 1 quarter of weakness is certainly given. Having said that, I think the GDP will also be critically dependent. The next quarter GDP will also be dependent on the monsoons, because agricultural production will play a significant part. And therefore, the next thing for the markets to watch out will be a good monsoon, I think, and therefore all eyes will be on that. The immediate expectation of GDP going up very sharply is not there. I think the markets don't expect that also. I think expectations are built around the 6.5% range, and therefore any spike will be positively looked at. So I think that's the outlook.
Girish, you were talking about as to how the market's next trigger is going to be an RBI rate cut. But do you think it's going to come about as soon as in the June review?
I think it's possible that it will come about in the June review, although the RBI had hinted earlier in April that there is unlikely to be any further rate cuts for the year. Hints of that, I guess. My sense is that with a higher base effect, inflation number should hopefully begin to look a little more benign from now on. Also, the fact that oil prices have now begun to soften will have an overall impact which will play out in the next 2-3 months. GDP numbers will look sluggish for this quarter, and therefore all these factors put together, I think the RBI should take a softer stance and cut interest rates.
Girish, do you worry about liquidity? Because so far this year, foreign institutional investors have pumped in about $8 billion, and markets, and we have a 4,800 print on the Nifty. What if they start selling?
Well, that is always the question. I think we've seen some amount of selling in the last 2-3 months, although that's been quite marginal. Most of the selling has come about from P-note holders because of the regulatory uncertainty. A lot of the investment that has gone in early this year has been, what we've seen is fairly, investments by long-only funds. And therefore, I don't see the prospect of a large-scale, exit from India from FIs. I think whatever all the issues before them have been placed and have been there on the table for the last 3-4 months. India is also globally, despite all the issues that are surrounding it, one of the best markets in terms of potential growth. If you look at problems in the US and Europe, I think India kind of stands out. There are issues which hopefully with a little bit of optimism one can hopefully look to getting over, and if that happens, really India remains a bright spot. So I don't see a major problem about FIs going away from India. In the short term, of course, you'll see some amounts of volatility based on the marginal flows, but large scale movement of FI money doesn't look like happening.
So Girish, give us 3 stock or sector names where do you think there is scope for bottom fishing and one can start accumulating at the current juncture?
Well, if the outlook, as I said, is that one what looking at, we are in an index where the P is about 12 to 13 for the indices, and if you're looking at a scenario where the interest rates will come off in the next couple of quarters, I think the best sector to play, I think, is the auto sector. I think some of the stocks have outperformed in the short term the last 3-4 months, but stocks like Tata Motors have begun correcting. I think the auto sector per se looks a good interest rate sensitive that one can play now. The other sector is if the private sector banks, and I know they have a huge issue of the NPAs, etc. But I think the private sector banks are relatively better off in this whole thing. If the valuations do come off, banking, private sector banks particularly, maybe another good bet to play. Infrastructure is a long-term call, and it's dependent a lot on structural issues getting resolved. So one can be a little cautious there. But valuations are so deep there that's the other sector that one can look at.
Girish, but what makes you bullish on autos? Are you bullish on autos just because we could see a rate cut, or are you bullish on autos because you think that valuations are attractive and these stocks have corrected quite a bit from the recent highs?
I would, the second point is right. I think the autos are probably, especially two-wheelers, are the most interest rate sensitive. If interest rates generally tend to go down, I think the whole economy gets a boost. Hopefully, we're banking on good monsoons. All these things put together, should boost demand. At the moment, consumer demand is quite strong, but consumer stocks are also very high. As against that, if there is a small, demand push that that is there in two-wheelers or commercial vehicles or passenger cars, I think with an interest rate cut, that's the best sector to play because the valuations are in your favor, and therefore risk return is in your favor in that sector.
But is the consumption trade now getting too crowded because just about everyone is hiding in consumer names? And why should one buy consumer names? Because inflation is high interest rates are eating into savings, and salary levels pretty much across the board. I don't know about your experience, but well, the chorus is that they've been static.
Consumer stocks are good because most consumer companies have a very clean balance sheet because they sell on cash, and therefore there is no overhang of debtors and stock and other things. So most of the balance sheets of consumer companies are clean. They are showing good growth, and return on capital employed of these companies are high. So in a environment where there's so much of uncertainty with most other sectors, money is kind of flocking to them because they're kind of safe havens. But at the valuations at which they are, I don't think it makes sense to add positions in these kind of consumer stocks. So while they may continue in the light of uncertainty prevailing, they may continue to kind of outperform and stay where they are. Significant upsides in consumer looks a little bit restricted at the moment.
So between HUL and ITC, which is a better bet?
I don't want to comment individually on stocks. I think ITC has a broader, diversified portfolio. The HUL is a pure play consumer play. I think both companies are doing reasonably well.
Girish, I know you're not going to talk about individual companies, but what is your somewhat preference when it comes to the two-wheeler segment? Because the export slowdown is a big concern, as well as the raw material price pressure.
As I said earlier, I think we are banking more on domestic growth in two-wheelers, and therefore, companies which have had export growth have had a good run. The global markets could continue to be good, I think, because the exports are to African markets and to other markets where the issues of the economies are not as problematic as in Europe and other countries. So to that extent, exports will continue to grow, although a little bit slowly as it seems right now. But it's more the domestic play, as I said, with interest rate cuts and with hopefully a good monsoon. That should give a boost to most of the two-wheeler industry.
At these levels, are markets factoring in a good monsoon, or as of now, markets are factoring in a neutral monsoon?
difficult to say that. I think at the moment the whole concern is on the US markets, on the European markets, also on the US, on the US markets, on the flows of FII money, on the issues in politics that are currently, that we're seeing right now. So monsoon, people, at least I haven't seen too much of media headlines and around monsoon. So I don't think the markets have kind of looked at monsoon as yet. So if it's a bad monsoon, it could be negatively taken by the markets.
So fingers crossed, if you don't get a good monsoon this year, will that lead to some kind of a climatic fall?
As I said, the valuations are at levels where dramatic falls seem restricted, whatever be the issues. Unless inflation kind of persists, for almost one more year, I think that's the only reason where we will see the markets falling off further quite significantly from here. Our outlook is that that scenario seems a little away at the moment, and therefore we are faced with a scenario where the downside is restricted. It is certainly there in the short term and the volatility will be there, but it's better to play for buy on declines and play for a year from now on, just simply because the valuation and risk return is in your favor.
Girish, final question: if someone walks up to you after this interview and his query is that, look, I'm ready to digest a 10% pain in the near term, but give me some ideas which could be 2x, 3x or even 5x in the next 3 years.
Well, as I said, I won't comment on individual stocks, but there will be lots of such ideas currently. Just to give you another sense, besides autos, the entire IT sector, the second rung stocks have actually very quietly performed, very well and outperformed the market. So there will be lots of pockets of outperformance on themes such as the weakening rupee, on themes such as interest rate cuts. You have to look at the macro picture. You have to play a top-down approach. Look at the macro picture. Look at what are the likely events, and then filter that down to individual sectors and stocks. But there will be lots of ideas that this will be a good year, I think, for stock picking and making money, I guess.